But we begin this half hour with the country's latest economic snapshot. On Friday, the Labor Department released a stronger than expected jobs report for June. The economy added 372,000 jobs last month, and the unemployment rate remained unchanged at 3.6%, just above a 50-year low. All this despite record inflation, high gasoline prices, and a volatile stock market. Here to help us make sense of it all is our CBS News business analyst, Jill Schlesinger. Good morning, Jill. So the big question, what are the main takeaways from this report?
You know, I think that the labor market is really entering a transition phase because we're just at the beginning of seeing job creation taper off. Now, what do I mean? You said stronger than expected report. Absolutely. But look at the first 3 months of this year. We averaged more than 500,000 jobs a month. Then you look at the second quarter, and then it's more like 380,000 jobs a month. And I think that that's what we're going to see for the rest of the year. Now, listen, there's no doubt about it. The first 6 months have been really strong, more than 2.7 million jobs created in 6 months. That's about 20% more than a whole year of average gains during the 2010s. So we still are in a strong labor market.
Well, on that note, then, Jill, with inflation we're seeing at 41-year highs of 8.6%, are Americans earning enough to balance it all out, to absorb these higher prices?
This is so difficult because what we saw in this report is wages up by 5.1% from a year ago. Normal times pre-COVID, this would be spectacular. But as you note, 41-year highs in inflation at 8.6%, a lot of Americans are falling behind. And you know how they're funding that gap? They're spending down the savings that they accumulated during the pandemic. Economists tell me it looks like Americans have spent about $600 billion of the savings they built up. We built up about $2.5 trillion of savings. That's how a lot of Americans are making do with these higher prices.
It's okay on the short term, but long term is where you start to worry. What about interest rates? We've talked about that each time where we do speak with you. How is this latest report going to impact the decision on interest rates?
Well, the Fed's going to meet in about 3 weeks, and I fully expect that the central bank will raise interest rates by another 0.75% at that meeting. You know, listen, the central bank is pretty clear. These high prices have got to come down. And by the way, the Fed has told us they are willing to see employment take a hit in order to bring down prices. So get ready for higher rates. Bad news for borrowers, but actually good news for savers.
All right, Jill, thank you for the perspective. We appreciate it.